Contracts for difference, or CFDs, are used by investors like you to trade on the financial markets, magnifying your buying power. You can use CFDs to buy and sell shares, commodities, indices, and currencies. So let's look at some examples of how you can use CFDs to buy shares. Using CFDs is similar to buying conventional shares. The main differences are that you can use leverage, go short, and avoid stamp duty. Let's assume you want to buy £10,000 worth of Barclays shares using a CFD. In this example, to gain exposure to £10,000 worth of Barclays shares, you part with only £1,000. This means that Barclays is available on a 10% margin. You're exposed to the same gains, losses and dividends as if you held £10,000 worth of the conventional shares. So let's assume the shares drop 20%. This means that you would lose your original £1,000 and need to settle a further £1,000, bringing the total loss to £2,000. Exactly the same loss that you would incur had you invested £10,000 in conventional shares. Conversely, let's assume the shares rise 20%. This means that you make a profit of £2,000 from an initial investment of £1,000. So on closing the trade out for a profit, you'll have your initial investment of £1,000 plus your profit of £2,000. For more details on CFDs with examples, please visit our website